Thank everyone who is here. Welcome back to our estate planning webinar series. We're thrilled to have you join part 2. This is where we plan on continuing to explore strategies, tools, updates that can help you protect your legacy and plan for the future with confidence. At the Legacy Group, our mission is simple yet powerful. Help individuals, families, and business owners build and preserve wealth across generations. We do this through our signature 3-dimensional planning approach. This integrates financial, legal, and accounting perspectives into one cohesive strategy. This collaborative process allows us to uncover gaps, identify opportunities, and create a plan that supports your long-term vision with clarity and confidence. Before we dive in, I'd like to introduce our speakers. Jeff Velastegui is the founder and managing partner at the Legacy Group. He is a seasoned financial planner with a deep background in tax-efficient planning and wealth preservation. Jeff specializes in helping high net worth families navigate complex planning scenarios with clarity and precision. Evan Rogdakis is our Director of Financial Planning at the Legacy Group. He specializes in estate planning, gift planning, and business succession planning. I also want to have a special thank you to Stuart Schoenfeld. Stu is our guest panelist. He is a partner at Capell, Barnett, Matalon, and Schoenfeld law firm. His areas of concentration include elder law and estate planning, business, corporate, and real estate transactions. If you joined us for part 1, you'll remember we laid the foundation covering the basics of estate planning, key documents, and common misconceptions. Today, we are building on that. We are planning on increasing the knowledge with a deeper dive into advanced estate planning strategies, including how recent legislative changes may impact your estate, your business, and your beneficiaries. We will also discuss how you can leverage estate tax provisions and share the various estate planning vehicles to use to achieve your financial goals. Whether you are a business owner, a high net worth individual, or planning for retirement, this session is designed to give you actionable insights and clarity in a rapidly evolving legal and tax landscape. We want to make this session as interactive as possible. Please feel free to drop your questions or comments in the chat at any time. We will be monitoring that. If we find time, we will stop midway through to answer those questions. If not, we will leave time at the end for a Q&A. With that being said, let's get started. At this point, I'd like to hand it over to Evan. Evan, if you would kindly do a brief recap of all we discussed at the last seminar and transition into what we will be focusing on today's, the floor is yours.
Fantastic. Estate planning is more than just wills and trusts. It's more than just planning for death. It's a strategy for building legacy, protecting what you consider important, your values, your assets, and how you would like your family to continue after you're gone. Includes a couple of key documents that are usually found in a comprehensive estate plan. I went over them in detail last time, so I'm just going to go super high level. Again, if there's any questions, just to reiterate, Rob, I'm happy to answer them. Go through them one by one, and we'll just talk about it for a few minutes. First one is a last will and testament. That's the testamentary document that everyone kind of knows. It lays the groundwork of what you want to happen to your stuff, your assets, after you pass. Often, you'll find trusts within that last will and testament, or standalone trust that we're going to talk about a little later for estate tax planning purposes. A trust is a separate entity that has its own rules that you, as the person creating, the grantor, often make up. They could be either inter vivos, meaning that it was created during lifetime and funded during lifetime, or they could be testamentary, which means that it's made or born out of the last will and testament. Often you'll get a number of ancillary documents with a comprehensive estate plan. First one's a durable power of attorney. Very powerful document. It allows someone to step in your stead for anything except healthcare decisions. There's a couple of different types. Some are the moment you sign it, they're in force. Other ones known as springing power of attorneys. They spring into effect if you become mentally or physically incapacitated. Healthcare directives are exactly what they think they are. They let the world know what you want to happen should you be in a permanent vegetative state. Often with those, you'll appoint someone to make medical decisions for you only if you can't. All right. The next document that is, or at least the next item that's often looked upon, is a beneficiary designation. Most people believe that the last will and testament, I'm done, I don't have to do anything else. A beneficiary designation will actually override, or it can supersede, is a better way of putting it, your last will and testament. So it becomes very, very important when you're creating a comprehensive estate plan, to look at your life insurance policies, your 401ks, that old IRA you haven't thought about in years. The who you name is important. Letter of intent, you'll find that often over a couple of different items, and it tells the family what you want to happen in certain situations, namely funeral presentations, how you'd like your remains handled, etc. Sometimes even personal items and personal property, where you want that piece of jewelry to go to, or that painting, that picture frame, and you can distribute assets that way as well. Guardianship designations, one of, if not the most important part of a comprehensive plan, is knowing who you're going to name as guardian of your child, your minor child, or incompetent or mentally incapacitated child. Should both spouses or parents pass away? Easily the number one item. All that other stuff is just assets. It's leaving behind, but who's going to actually raise your child often becomes the most important decision you'll make out when creating a comprehensive plan. And then really what we're focusing on today is going to be tax planning strategies. I think Stu will be discussing it in a little bit. Whether you want to call them estate taxes or death taxes, they are punitive in some states and then federally as well. And so how do you plan for them becomes a very important part if you hit those numbers. Rob, if you next slide, please. So last time we spoke about everything beneath that testamentary line. So what you're planning for during death. Today, we're going to be focusing on that lifetime planning, that inter vivos. How do we lower what might be due at the time of death? Yeah. Jeff, you're on mute. Sorry.
So why estate tax laws matter now? Well, that's something that we always talk to our clients. You always have more options today than you'll have tomorrow, right? Doing this for almost 24 years, I can tell you that estate planning is a moving target. It's never a one-size-fits-all type of solution. So I think that, given our recent changes, which we'll talk about today, I think that understanding that, your intent, what you want to happen with your assets, I think it's an important thing to really consider as you consider how much time you have for planning. So with that, one of the things I love, one of my favorite quotes that, growing up before even I got into this business is this one here by Ben Franklin, right? There's no certainties in life except death and taxes. When I first heard that, I might have been in high school, but I can't tell you how applicable that is, and given the line of work we're in. So, this is something that he said back in the 1700s, specifically talking about our tax system and how punitive it was back then, right? It hasn't gotten any better, right? And I think that's one of the things that why we do what we do and enjoy talking about this stuff. So let me show you a really simple way of looking at estate taxes and how it applies to people, right? One of the key things that we talk with individuals about is obviously planning today the planning today is better than planning 10, 15 years down the road. And how it applies to you is that the unified credit threshold today in 2025, if you're a married couple, is just shy of $28 million, which is a lot of money. But what does that actually mean, right? The estate tax is applied to anything above that line, right? So anything above that line, if you're fortunate enough to have that amount of wealth, it's going to get split 60% to your heirs, 40% to Uncle Sam, the IRS. I don't know if many of you have noticed the word the IRS actually spells out the word theirs. They genuinely do believe it's their money. They just haven't come to collect yet. So, and they quite frankly don't care how much you grow your estate, because the more you have, the more they will eventually get. Now, the last thing I'll say about this is, if you understand the diagram on the left side of the page, this might change your perspective as to what you're doing today in terms of just planning in general. If you're above the threshold of $28 million, you have a bigger problem than that. And that is that every year you have growth and income You do three things with it. You spend, you pay taxes, and you're obviously saving. But unless you're doing intentional gifting and planning, which we're going to talk about today, that savings is going back to that 60-40 equation for Uncle Sam. So with that, I want to, really excited to bring Stu to the forefront of this conversation, because Stu has been a long time, friend and colleague of mine for almost 24 years that I've been in the business, and I've been really excited to have you take us through some of the changes in the big beautiful bill that just got passed. So, Stu.
Thank you. Thank you, everybody. I'm very happy to be here, and I really appreciate the opportunity to join this very distinguished panel. So the main, interestingly, with, of course, one of the things that keeps people like us, and I speak a lot about my colleagues who are attorneys in business, is that oftentimes we get clients in to plan based on the fact that it's going to be a change in the law, or who nobody knows what's happening tomorrow. And that's really the case, because although this change is permanent, who knows? So we've been living for the last few years with this idea that the exemption, the estate tax exemption, how much you can give away during your life or at death without paying taxes, be it gift taxes or estate taxes, that there was going to be a time when the exemption really was cut in half. Right now, today, the federal exemption is almost 14 million. It's 13.99 million. And we've been telling everybody, hurry up, do your planning before the end of 2025, because we don't know what's going to happen. Well, sure enough, now the big, beautiful bill was passed. And what that did is it made this exemption permanent. And actually, as of the beginning of next year, the exemption is going to go up to $15 million. And I'll explain a little bit about what that means. And then it will be adjusted every year for inflation. So it will continue to go up. How long it's supposed to be in there? Forever, but it'll be there until it's not there anymore. So it just gives you, it just lets you know that everything that you think may be permanent is not necessarily permanent. And keep that in mind. And that's one of the reasons we should still get planning done. Now, so for those who don't know, everybody gets to leave $15 million, whether during their lifetime or at death, to anybody they would like. And they're free. That is the exemption for estate taxes. If you're a married couple, it would be double that. And so the idea is, for those who have net worth that is, let's say, higher, is how do we get the best use of this exemption? We don't want to lose it. Now, I'm going to give you one quick example, and before I move on, if you have a typical simple will, or that you see an I love you will, the husband and the wife, the husband leaves everything to the wife, I love you, wife, and then when the wife passes away, it then goes to the kids, or vice versa. That's wonderful, and the government is happy, because when husband dies, assuming the husband's died first, he leaves everything to the wife. Well, there's never estate tax between husband and wife. And so the federal government says, that's wonderful, because now all of their joint assets are bulked up in the name of the surviving spouse. Okay, so picture two folks with each a husband and wife with $7.5 million each, and the husband dies and leaves that $7.5 million to the wife. Now she's got $15 million, and she's really just used up her exemption. Had the husband done some effective tax planning, it would have been probably worked out a little differently. $7.5 million times 2 is still, that's the exemption. But what if it was $10 million in each person's name? You could see it's a problem. Okay, next slide, please.
Stu, great job going over some of the changes that we're going to be focusing on, and how it's going to affect everyone on this call. Given our tax code and how it is written, most people fail to realize that while the code creates the problem, it also provides a solution. Understanding the code, it's how you create leverage. And what we're going to go on to now is using that code to the advantage of those on this call and those that we work with, to making sure that they're being the most efficient in how they plan.
So leverage is a very important word, you know. I mean, I actually spent some time looking it up today, and it's really about exploiting and getting a lot. You know, companies use it by borrowing, and therefore they're putting less of their money in to get a greater return. And in the estate tax realm, it's about giving your money away or transferring it to the next generation, or meeting your planning goals, and giving as much as and accomplishing those goals as best as you can at minimal cost, by and particularly taxes. And so what we're going to do what we're doing today is saying, here's a sample of some ways we can do that. And what we're talking about here, of course, is controlling what we can. How do we invest it? What's the best way to do it so that we get the most return to our money, and have the most money really to pass down to our kids, to our grandchildren, for coming generations, and meeting our goals. Okay, this is somebody else's.
Evan, if you could jump in and focus on these slides, I would greatly appreciate it.
Sure. So as Rob mentioned, the IRS creates the problem and they give you some type of solution. The first one is your annual exclusion. So I, if I so inclined, would be able to give everyone on this list $19,000 per person, per recipient. So it used to be 10, sometimes you hear 12. It really depends on how old the financial professional or attorney you're in front of. But currently that number is $19,000 per year. And it goes up with inflation, and it ticks over at every $1,000. So if I'm able to give you $19,000, my wife's also able to give you $19,000. And so that would also be $38,000 total. No forms necessary. Nothing has to be done. Just I'm allowed to give you that. And that money now sits in your account. Not the greatest way of doing it, because now you control it. Or I could do it to my children. And so that might not be the best way of doing it. And Stu's going to talk a little later on more efficient ways of using that $19,000. In addition, if I go over that $19,000, I'm allowed to give up to my gift exemption amount without incurring estate taxes. I file a simple form with the IRS that says, hey, I used more than $19,000 to benefit Pam, let's say. And so they will take that dollar amount off of that exemption amount, that lifetime number of 13.99. And we'll show you an example in a minute on how we use that to our benefit. In addition, keep going back. Go back there, Rob.
Sorry about that.
And in addition, there's a generation skipping exemption amount. So someone might be on here thinking, I'll just give everything to my grandkids and we'll just skip that whole next generation. IRS thought about it, 1986. So what is that, about 40 years ago? They fixed that problem as well. So there's this parallel tax system called the generation skipping transfer tax. And it's locked in step with those numbers, the 13.99 plus what Stu mentioned earlier, the $15 million. So just leaving it and skipping that whole generation in the middle doesn't always work. There's planning techniques you can do it. The last part of the exemption amount list that you should know about, exemptions, exclusions, all that work stuff, is the marital deduction. I can send anything to my wife, whether during life or at death, unlimited. Seems to be common sense, feels right. We share in it. Everything's ours anyway. I should be able to give her those assets, but that wasn't always the case. That changed in 1981. So unlimited marital deduction, and there's ways to plan for that, especially if you have spouses that have uneven assets in their name. So Stu's next slide, Rob.
Before we get up to the next slide, there was one question.
I
don't know if we're going to specifically answer this question in some of the next slides, so I'd like to just take a minute. Hypothetical situation, Stu, Evan, either one of you can chime in on this. If a son were to create an irrevocable trust where the mom is the discretionary income and principal beneficiary, mom is given a general power of appointment exercisable with consent of a friend. Will this structure affect mom's NY Medicaid eligibility? The purpose is for the assets in the trust to get a step up in basis on mom's death.
Fantastic. Stu, I'll let you go for it.
Okay, so as part of, just so you know, a lot of my practice is elder law. As a general rule, when we do and we are worried, not worried, but one of the planning goals is to create estate inclusion for folks who are doing that, because most times their estates really frequently are not even going to be in that taxable range, but you certainly want to get your step up in cost basis. We generally don't do a general power of appointment. We do a special, a limited power of appointment, and that's one of the ways we achieve a step up in basis. The other thing which you mentioned about discretionary income, you would never, and I underline never, have mom get any principal out of the trust. That would be fatal to it as a Medicaid trust. So that would never work. And usually what we do is make mom the mandatory distributee of the income, is how we usually draft it. So that also would help us get estate inclusion and our step up in basis. But generally, we don't use a general power of appointment.
Thank you, Stu. Evan, we're going to get back to you, and maybe you can start going over on ways that we can use our credit.
Sure. I know there's two Stews here, but for Lipsky, who asked the question, I think that is going to be an interesting area of the law with gifting and trying to get step up in basis. It wasn't utilized that much. But given the high exemption amount, and if I have 13 million, but I'm not worth 13 million, but I can get capital gains step up, I do think that that's going to be on the forefront of estate planning come the future. I think it's a really interesting area. And seeing, you could also see that I know this has nothing to do with it, and Rob's going to yell at me and Jeff in a minute, but it's gonna be fraught with issues later on, as if you gave it to mom and then mom's will said to my children equally, and now you kind of just enriched your 3 children or 2 children. You just see the litigation that's going to happen from it, but very, very interesting. So you can use that credit, as I mentioned, at death or during life. So just wanted to give a quick example. I know that we have people from all over the country. There's 18 states that are decoupled. I use New York as an example. And when I say decoupled, New York, along with those other 17 states and District of Columbia, have their own estate tax numbers that you have to worry about. So the other 30 some odd states, they just use the federal. So in this example, I just took the 13 million. I said, if you kept it today and it grew at 5%, it would grow to about $35.5 million. And then you'd have to split it with New York and Albany. And so if you click it one more, there you go. And so they get their shares as well. So Albany and DC will take their piece of it, and the estate gets the remaining amount. If, however, I were to use that 13.99 million and I gifted it away to Pam, let's say, I think Jen, my wife, would be upset, but I'm gonna give it to Pam anyway. And then she grows it 20 years, and then they would skip the estate tax on that level, even though she's my contemporary. So it was able to go into a box for Pam's benefit. She got to use it a whole entire life. And then that box received that $35 million estate tax-free. Eventually, it would hit a generational issue, but at least I was able to save a large amount with estate taxes. Most people don't use their entire exemption unless they're north of certain numbers, but this is just that extreme example that if we were gifting it away today and it was compounding in someone else's estate, especially if they're younger, there would be a beneficial, it'd be a beneficiary. There'd be a benefit to the family as a whole.
Evan just gave a great example of the benefit of transferring the assets in your lifetime as opposed to waiting to death. What we're going to discuss now is, if you agree with that sentiment, how is it that you transfer it and what is it that you transfer to? Stu, if you could you kindly go into some trust work and some ideas and practices that our listeners can have potentially put in place for their planning?
Well, I think what you're asking, at least with this slide, is starting with what I see as the basics. So everybody gets on on the Sage page, and then we can go into some specifics get back to that concept of the benefits of the leveraging. So it's important that everybody understand what a trust is, because and I don't know about my co-panelists if they find this, but everybody says, gee, I need a trust. And I say, why? You know, but it is that knee-jerk reaction today to say you need a trust. And so it's important to at least understand very, very briefly in a minute or two what a trust is. So in its simplest form, let's say somebody has a minor child and they're creating an estate plan, and they say, well, if I were to die and my spouse were to die, then who would take care of my child's money? Who would make sure it's available for their health and their support and their education? And then when they become hopefully an adult that's responsible, give them whatever's left at that point. Who would do that? So that's in essence what a trust is. You're giving assets, you're giving resources to somebody to hold them for somebody else. In its simplest form, that's what it is. So the person who creates the trust, who sets up the trust, is either the settlor or the grantor or the trustor. All different ways, different jurisdictions have call it different things. And that's the person that created the trust. And the person that is going to be that young child is the beneficiary. And again, it doesn't have to be a young child, just in this example, though they are. It could be a disabled child, or it's just anybody. And the trustee is the person in charge. And the trustee could be one person or two people, or it could be an institutional trustee, as many people use. And sometimes it's even the grantor or the settlor themselves acts as the trustee. So you could see it's arrangement where you're taking resources, assets, and you're creating a fiduciary agreement. You're creating a situation where somebody's going to, hold these assets, manage these assets, and there are going to be rules for how they ought to be, how and when, and for what purposes they are going to be distributed, and who's going to get them, who are the beneficiaries. Now, remember what I said, every trust has a purpose, and we're going to go over some of those purposes. But really, there are two kinds. Okay, there are ones that we create at our lifetime, and those take effect right now. And sometimes we think of those as living trusts, right? Lifetime, and some that take effect when we pass on, and those are called testamentary trusts. They're usually in our will. And the ones, of course, in our will really are for assets that we're only going to give away at death, because that's when a will speaks. But sorry about that. Don't they know I'm doing this? But during our lifetime, we could create trusts. We could create trusts that take effect now. And those come into those are two types. Revocable, ones we could rip up, tear up, change in any way we want, and irrevocable, ones we can't. Okay, and those are the two types. And what determines which way we're going is what are you doing the trust, client? What's your reasoning? Okay, next slide. So if I could just go on in this slide, I'm just gonna go quickly. These are some of the main reasons. Now, the ones we're focusing on today really are more tax-related, passing assets, resources down to within your family, or to carry out your donative intent. But there are a lot of reasons we do it, and that will determine what kind of trust we're doing, and how they're drafted. Because one thing you have to understand, especially if you know that much about trust, all trusts are not created alike. The way they and if you go to somebody who is drafting all their trusts alike, it's the wrong person, because they're not really understanding what you want and how to make your goals happen. Okay, so here are some goals, and I'll run through them quickly. The first one, you want to avoid probate. Let's say you want your assets to pass to the next generation or to your spouse easily, without any delay, without paying a lot of people money to lawyers and accountants. Well, accountants you'll pay anyway, but you want it just to go easily, without any delay whatsoever, without fighting. That would be usually what's called a revocable trust. Easy to do, no tax consequences to it. If you're coming back to the question before, if you're creating a trust to start that 5-year Medicaid clock ticking, that would be an irrevocable trust, and where you're thinking, let me protect my resources so that if I should need long-term care, be it at home, bring it in a facility, I can get it. Okay, if you have a child who's has a little rough time managing assets, if you want to, and I'm just running through this quickly, if you want to establish generational wealth, you want to think, you're thinking about your grandchildren and your great grandchildren, you have the resources where you can make an impact through the generations, generational wealth, it's wonderful. Preserving assets for government benefits, that goes along with the nursing home one. If you have a child or a relative who you'd like to leave money for, who is on SSI or on Medicaid, is disabled, what you want to do for that child or that individual is you want to give them a quality of life. Now, this one's not even a tax purpose so much. You want to give them a quality of life because Medicaid, SSI, they typically don't provide all of those types of things. They don't provide that quality of life. So how do you do that? How do you provide the quality of life to somebody who is in need of government benefits, who is disabled? Protecting minor kids, we talked about that one originally. You get that. Little children cannot really and should not own assets. And remember, we want to, and if we want to have money go to them efficiently with somebody we love and we trust is making decisions for them, but at the same time, we don't want to have judges monitoring it. We don't want overseers that we don't know in our business. So good planning will do that. Protecting our spouse, dealing with special situation in second marriages. If we want to have assets used very specifically, eliminate taxation. Well, that's a lot why we're here today. Okay, you know, and when you do estate planning, the life insurance trust, we'll talk about a little bit, is a low-hanging fruit because it's such a natural. But it's a very easy way to leverage and to pass those life insurance policies to your spouse, to your children, ultimately pay no tax on the proceeds. Reduce and eliminate estate tax. Again, we're going to go through in another slide or two some of the ways to accomplish that. Estate taxes, charitable giving, you could all get that. And some people, I mean, if you're famous like me, I don't like people knowing all my business. So privacy is a very oftentimes important for some of our clients. I know I ran through that very quickly. I think this one is still mine. So what can you put into a trust? I mean, you really could put almost everything, okay? And it doesn't mean you should put everything. But again, if you have the right goals, if you would put money in there to help you meet these goals and make sure they happen. Because remember, none of us are getting out of here alive, so it's good to make this happen. Certainly your house, there's ways to transfer the house, liquid assets, business interests, and have the same, by the way, tax treatment as if it was in your hands. For example, with a house, if you sold the house you live in and you're married, you could exclude the first $500,000 of profit. Well, guess what? We could even do the same thing. We could put it into an irrevocable trust, and if the trust is created the right way, we could still have that $500,000 exemption. And so we're all of us are very mindful of the tax goals of our clients. And these are all assets that can go in, business interests. If you have an interest in a business and an operating business, you're trying to pass it down to the next generation or whoever's going to take it over, it's a great asset to put in, especially we're going to get into the leveraging business a little bit. Life insurance as well. Let's just say that well, I will come back to that, but life insurance, retirement funds themselves, you don't put into trust, but who the beneficiary receiving the funds, they could have the money in trust. So if I leave money to a disabled beneficiary, I could have the money in a trust where their benefits are protected, and yet they have this income to create a quality of life, and it's all good. I know I run through that very quickly. I apologize for that.
So this is also supposed to be your slide.
Still me. Okay.
Yeah,
So,
but let me yeah, go ahead. This is the
no, go
gifting.
ahead. Go ahead. You could go.
Well, this is, this is one where we start talking specifically about the annual exclusion gifting, right? So, I think that one of the things that people fail to recognize is how powerful annual exclusion gifting can be, right? Especially if you have, 2 or 3 kids plus some grandkids. So, Stu, could you just walk us through kind of how you have helped clients over the years, right, implement some of these things, that implement gifting to an irrevocable trust, and what kind of things, right? And I think earlier you said you were going to talk about life insurance. This is something that we do often to maximize those those dollars over time for clients. So
Well,
just elaborate on that for us, if you don't mind.
yeah. So let's look at this. It's based on the annual exclusion. So that's for those who aren't sure. Everybody, you can give $19,000 to anybody you would like every year, and it's a really simple way to get money out of your name. So if you've got 2 parents and they could give $38,000 to each one of their donees, each whoever they want to give money to, and using this example, they can give, if they have 3 kids. Look at that. They can give $114,000 away each year. And it doesn't go against their lifetime exemption, that's going to be 15 million. You could just do it. I mean, I can't tell you how many clients always at the end of the year we say at Christmas, give everybody the gift, and then January 2nd you could do it again. But look at what you've done here. So you've given taken 114,000 out of your name for just 3 individuals, 3 donees, 3 gift recipients, and then and really there's no reporting, there's nothing you have to do, and you would put it, let's say you put it into an irrevocable trust, because part of putting it into an irrevocable trust is getting it out of my estate. So I don't want it included in my estate anymore. But now look at this example, that assuming a growth rate of 5% over 30 years, that 114,000 could turn into over $8 million. And so the leverage is unbelievable, because you handed no money to the government. It didn't take away anything from your lifetime exemption. And it's so simple, right? Anything, Jeff, you want to add?
Yeah, no, and more than anything, just before we go to the next slide, this is one, a credit that it's a use it or lose it, right? It's not one that if you don't take advantage of it for the last 10 years, you can't go back and retroactively take advantage of it. So it's a very powerful one, very popular tool. It's typically where we begin, when we take clients through a planning process, we generally try to, gift assets or income that they don't need, right? So this is just an example that illustrates how powerful, right? If you had an extra $100,000 of disposable income, what that does over the course of 20, 30 years for your family. So Rob, can you go to the next slide so that we can just start talking a little bit more about another powerful strategy that we talk about often with our clients, which is a SLAT, okay? That is an acronym that stands for Spousal Lifetime Access Trust. And why I like this, talking about this with clients, is that oftentimes people fail to plan because of losing control, right? Control is important to people, right? They think that they're going to, unnecessarily give something that they may need in the future. And a SLAT essentially is a spouse. So let's say myself, right? I give as the grantor, make a gift to a SLAT for my wife, Pam. She can use the assets or the income inside of the asset throughout her lifetime for any reason that pertains to her health, education, maintenance, and support. So as long as Pam and I are still friends and love each other, that's a good thing, right? Because if I put in, a piece of real estate that throws off income, right? She can take advantage of that income even though it's part of a trust and outside of my estate for estate planning purposes. So, Evan, could you just help me elaborate a little bit on this slide
Sure.
and really just what it really does for clients and that we've worked with in the last almost 2 decades. Talk to us a little bit more about how you see this from a legal standpoint.
Sure. Where this is often used is building on Stu's example before. I would like to give $114,000 away to my kids. I have the means. I don't need it in my estate. It's not affecting my my lifestyle, my needs for health, education, maintenance. It's not really affecting that amount. So I can give away the 100,000. But what if I want it back? What if I need it back? I don't want to go to my children and say, can I have the money I gave you 5 years ago back? So this provision is often built into a trust where let's say Evan, creates a trust for the benefit of we'll use Pam again. And Pam's everyone's wife here. And then when she passes, down to our children. And all of a sudden I need that money back. Or happens in a lot of cases, you have a falling out with a child or a grandchild, and I don't want him or her to inherit this money. I want an escape hatch. So Pam, as the spouse, during her lifetime, she has access to the trust. It's an acronym, that's where it came from. And so we can pull the trustee, usually would be an independent trustee at that point, would be able to reach into the trust, into that box, and pull out money for Pam's benefit. Once Pam has the money in her checking account, maybe she shares it with me, maybe she doesn't. But either way, we created an escape hatch. So Jeff and our goal is often to build in control without ownership. Control means I get to control that money I gave away, but I don't lose. I lost the ownership, but I still have control because I can rip it back. I have an escape hatch.
Yeah.
And so that's where SLATs
Evan.
often
I mean,
used.
if I don't mind, if you don't mind just me cutting in, I mean, I think that's a powerful statement what you're making, which is, and we say this often, right? The best way to be wealthy is to own nothing and control everything, right? And in the case for real estate and income is everything for a lot of our clients. So, we've helped thousands, not thousands, we've helped a lot of people over the 23 years we've been doing this, really take control of that, right? And look at that a little bit differently. So very powerful, very,
So a SLAT is built on. It could be built onto that lifetime exemption trust. It could be built onto a larger gift. It really is just a provision within a trust that says, hey, I need a way out of this thing, and that's how you would get out. It's not often built in, just building on the one question we have. It's not usually used, or it can't really be used on Medicaid trusts. A revocable living trust to avoid probate already has it kind of built in because you can amend it and change it at times. So when you use these trusts, to Stu's great point earlier, is I need a trust is not usually the beginning of the conversation. It's why do you think you need a trust? And once we understand that, you can apply one of the 17 that were in that list that Stu started to use, or the 9 of those steps that we had for gifting. And then you can start applying that to your family situation and your family dynamics.
Evan, can I just ask you that? Now, do you see a lot of times where 2 spouses will create a SLAT for each other?
Absolutely fantastic point. So yes, we call them cross SLATs. So I would create one for the benefit of my wife, and my wife would create one for the benefit of me. There's this thing called the reciprocal trust doctrine, but that just says they can't be exactly the same. So you make them a little different. Sign them on different days. The children get it at different times, easily avoidable. But yes, we absolutely would create them, and then you would separate those gifts. So instead of doing $114,000 into one trust in that example before, we'd split them up and put 50-50. That way that if something were to happen and my spouse were to prematurely pass away, at least I'd still have access to the other trust. And assuming I still get along with my kids, I still might be able to get the first trust. And so a very common technique known as a cross SLAT.
I think we go to the next slide now, yeah.
Oh.
And Yeah, Sue, this was, you were gonna.
Yeah, so let's, we're building on all these earlier slides. Interestingly, as I'm talking and I'm listening to Jeff and Evan, and we started with annual gifting, which is very, simple, low-hanging fruit, no tax returns have to get filed. It's just between you and your family, and you set up this trust so the money's controlled. And then we talked about a SLAT, which really, to do that tax-free, of course you would use some of your lifetime exemption. And so now coming back to that concept of leverage, okay, how we can give away money. Are there techniques where we get a better bang or good bang for our buck? So here are a couple of ideas, and I'll just go into them a little bit. The ILIT, that's an irrevocable life insurance trust. So picture a life insurance policy. Let's say you have a whole life policy, and you have, I'm making this up, $100,000 of cash value in that policy. But when you die, and you own the policy, when you pass away, the insurance company is going to pay your beneficiaries $1 million. Sounds great. Okay. Now, and people often, clients say this to me all the time, but I heard you don't pay any estate taxes on life insurance proceeds. I've heard that a lot of times. Well, the answer is there's a way not to pay estate taxes, but that's not automatic, because on that example, if I own that policy, okay, yes, today it's worth $100,000, but in my estate, the day I pass away, it's worth $1 million, because that's the amount of the insurance proceeds. So what would happen if I gave the policy away today to an irrevocable trust? Well, the gift is not $1 million. The gift is really roughly $100,000, right? What the value of that policy is today. And I put that into an irrevocable trust so that it's protected from my rotten kids. And look at this. And I can have it available while my wife is alive to help her with her standard of living after I'm gone. She could even be a trustee. But listen to what just happened. I gave away $100,000 to a trust, and my family ended up with $1 million when I die, tax-free. So all I've used is $100,000 of my exemption. So what did we do? In essence, we've leveraged. We got that insurance trust, those insurance proceeds out of my estate. And most people, to be honest, are not spending the cash value while they're alive. So they don't, most times clients don't care that you're taking that out of their name. Great planning technique, and it's used all the time. The next one is an IDGT, an intentionally defective grant or trust. I think this is one of my favorite names in all of the world of estate planning. But basically what that means is this. Well, so what is a grantor trust? A grantor trust is one that, in essence, speaking very simply, means that during the lifetime of usually of the grantor, the person that created the trust, it's treated as if that person, the grantor, still owns the asset. So, for example, if you have a grantor trust and the grantor trust owns a residence, and this comes back to the question about the Medicaid trust. It could, because that would be a typical situation where you would see that with a grantor trust. If a house, if the house is in an irrevocable trust, but yet if the house is sold while the grantor is alive, they still get to take the $250,000 exemption. They still get to deduct their real estate taxes if it's available. So it's treated as if it's theirs for income tax purposes while they're alive. What's defective about it is that when the grantor is gone, when the grantor passes away, it's out of the grantor's estate. So yes, it's in while they're alive for income tax purposes, but it is intentionally out for estate tax purposes. So here's an example, okay? And by the way, it doesn't have to be a gift. I'll give you an example. I have a client with a piece of real estate, or it could be a business that's worth a sizable amount of money, and he takes a portion of it and he gifts it to an IDGT, and he takes a portion of it and he sells it to another intentionally defective grantor trust. Okay, so we have two things there. Now, let's first talk about that concept of leveraging. He gave a portion of the building. Okay, he didn't give control. He didn't give voting rights. He did give a right for these beneficiaries or the trust to collect the income if it's a building. So they get income, they get benefits that way, but they don't have control. They don't have voting rights, especially if they have they have only 20% of the building. And I mean, how do they vote? So what does that mean in English? That means that if you're giving away, if you take a building, the building's worth $1 million, and you gave away 20% of it, and that 20% should be worth $200,000. But wait a minute, that 20%, they can't vote to sell the building because they don't have the power. They don't manage the building. They can't make decisions. So is that 20% really worth $200,000? Answer is no. And that's where you start to see this concept of leverage, because now we're giving away 20% of that building, but we're not using, let's say in that case, $200,000 of our exemption. We may be using less, maybe it's 30% less than that. So there's a discount. The gift is less than what the straight fair market value is. And so that's just an example. So here an IDGT, it's still a grantor trust, okay? So your grantor is paying the income taxes, gets the income tax benefits, but at the end of the day, the asset that's in that trust is out of the estate of the grantor. And that's what does it. Again, you combine a lot of concepts here that we've talked about where this could be so powerful and advantageous to the grantor. Anybody want to add anything? I'm trying to go through very quickly.
No, we're good. We're just running.
You're great.
A few minutes before we, we start losing people. We want to try to wrap it up.
Yeah.
You know.
Yeah. So I'll jump into the next one, a GRAT. Actually, I had the pleasure of being with Jeff and Evan at a meeting, and Evan did a great job explaining it the other day. But a retained annuity trust means you're essentially giving an asset to an irrevocable trust, but in return, the grantor gets an annuity, gets paid back over time. Okay. And so it's and what's important about that concept, in essence, you're giving the money, you're getting money back in an annuity. You're getting money back. And so hopefully, so what happens? You give, let's say you give stock that's worth $100,000 and you transfer it into a GRAT. Okay. And so the GRAT, yes, over time, over a period of time, has to pay you back an annuity. And let's say it uses the federal rate, the minimum rate that you're permitted of 5%, but the stock that you transferred in may be appreciating much more quickly than that. So that appreciation is out of your estate, even though the base gift is slowly being returned to you. And so again, you're leveraging it's really a fancy way of doing this same concept of before. You put something in, it appreciates. But with a GRAT, you can even reduce or eliminate the gift tax consequences, where it's a zero gift. You put the asset in, you may get it back every other year, in essence, and keep giving it back with what's called a rolling GRAT. But you're using potentially zero of your exemption. So it's a really powerful gifting technique. And again, I know these are more complex, and I'm not, but you understand the concept of leveraging your gift so that basically you're taking the appreciation out of your name. You are using discounting, as we talked about, using the fact that it's a grantor trust, and you continue to have the grantor paying income taxes on it. you're transferring more and more assets out of the grantor's name to the beneficiaries through the use of these trusts. And as I said, the leveraging is very, very powerful. And the last one I'll just touch on for a minute is the generation skipping dynasty trust. Now, the whole idea here is that, well, and I think, as Evan mentioned, the generation skipping transfer tax. So I don't have to go too much into that, but let's say you want to set up a trust that ultimately benefits your grandchildren. You could use your lifetime exemption to do that. And guess what? All the appreciation is in that trust. You don't have to, on an ongoing basis, pay estate taxes on that money, and it builds and it builds. And money can come out for your children, for your grandchildren, your great-grandchildren, etc., for their health, whatever it is, health, education, support, however you want to draft it. Essentially could be even out of their estate, and it just appreciates for many, many years. So a great way using the generation skipping transfer tax to create this very long-lasting legacy for your family. So these are just, these trusts all focus on, you see, estate tax planning. It's just one of the purposes, but you could see how using these trusts create this way of transferring down and minimizing the taxes. It's great.
Next slide, Rob. So thank you, guys. Obviously this is, we're coming at the end of our time here. I want to thank Stu and Evan and Rob for helping me get this information out to everyone. But, as you consider all the information we went through over the last, 45 to 50 minutes, I mean, it's a lot. We're not expecting anyone to become an expert on estate planning. The goal, obviously, for us is to educate, to, create awareness around your planning options. And as you consider, planning is a journey, right? For us, it's always, your journey, not our journey, right? And what does that mean? That means that, when you go through a planning process, it should be focused around what matters most to you, right? What are your goals? What are your aspirations? What is your intent? And as long as planning is focused around those things, I think that the best planning comes out of it. One of the things that we have been able to do over the years is help people, achieve those financial goals, whether it be asset protection, estate planning to reduce estate taxes, transferring a business to the next generation. At the end of the day, the solutions, really are, coming from the initial conversation with people, which is when they're identifying what it is that they want us to help them with, right? And oftentimes just asking the right question is what we have to do to arrive at that. So with that said, I want to thank everyone for joining us this afternoon for our second of 4 in this series. And I know I'm probably forgetting to say a few things. So Rob, I know there's a few things that I always forget. So thank you guys, everyone. If you have any questions, please, we're going to stick around for a couple more minutes while we wrap up here.
Yeah, if I could just add again, if there's any questions, please type them in the chat. We'd love to answer them. Again, thank you all for your time, for attending, and we hope you found it valuable.